It's almost 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Yvonne Man. Here are the top stories this morning. The first debate in the U.S. presidential rematch sees Joe Biden and Donald Trump trade accusations over the economy, foreign policy, and their fitness for office. Also ahead, India is set to lure billions of dollars more inflows from today as J.P. Morgan adds the nation's government bonds to its emerging markets index. And Asian equities gaining ahead of the Fed's preferred inflation gauge out later Friday. Japan's Topix is set for a 34-year high. So it was a 90-minute sort of exchange here with President Joe Biden stumbling through exchanges as he faces off former President Donald Trump in their first televised election debate. The candidates sparred over the economy, abortion laws, and geopolitical issues.
It's just going to cost countries that have been ripping us off for years, like China and many others, in all fairness to China. It's going to just force them to pay us a lot of money, reduce our deficit tremendously, and give us a lot of power for other things.
There's more to be done. There's more to be done. Working class people are still in trouble. I come from Scranton, Pennsylvania. I come of a household where the kitchen table, if the things weren't able to be met during the month, it was a problem. The price of eggs, the price of gas, the price of housing, the price of a whole range of things. That's why I'm working so hard to make sure I deal with those problems.
Let's check in the market reaction with Avril Hong joining us out of Singapore. And Avril, we didn't expect this debate to really kind of spur a whole lot of volatility, but you're seeing a little bit of a movement in the currency space here this morning. I think the dollar certainly has been a bit more favorable. What are you watching out for?
Yeah, I think the greenback reaction is quite interesting as it spiked while the debate carried on, and it's paired some of those gains. I'll take a deeper dive into it in just a bit, but it's also interesting as we watch out for the reaction in the Chinese currency. We actually saw it starting the morning session, so to speak, at 7:30.65. This was when the debate had not yet just begun, and then, if anything, it's actually strengthened since we got that progress on the debate. And it seems like maybe investors were bracing for a bit more of hawkishness towards China. Maybe there's a bit of relief, but it could also be some of these domestic Chinese factors at play. We did see the PBOC coming through with a bit of a modest pushback via the yuan fix, onshore yuan also moving towards the 726 level. That's interesting to see. But across the rest of the asset classes, we are seeing stock markets actually tracking the gains on Wall Street overnight. This was as investors passed the data coming through. It was a bit of a mixed bag on the U.S. economy, right? That revised downwards personal spending. Then we also got some of these weak job numbers. So stocks are doing well. We're also seeing the topics. We're keeping an eye on it. Might close at those 34-year highs. But taking a deeper look at what we're seeing on the dollar, there's the spike there. Of course, against this backdrop of the U.S. presidential debate is really about those PCE numbers out of the U.S. tonight, right? And think about how, as well, the first half of the year was really dominated by the Fed risk. The second half, it might be that as well as the U.S. presidential election to consider. Let's flip the board and take a look at how the cryptocurrency Bitcoin was faring during the debate. We actually saw that spike pairing some of the gains as well. It's not that easy to pass why exactly the cryptocurrency fared the way it did, but Trump has been making some overtures towards the industry, and he's seen as someone that is perhaps more friendly towards the digital asset than perhaps Joe Biden. Yvonne.
All right, Avril, thanks for the update here as well. Let's get to our political news director, Jody Schneider. She joins us now from Washington. And Jody, people are debating who won this debate. There wasn't a lot of policy discussion tonight. What do you think characterized each man's performance?
Yeah, it really was not a policy-driven debate at all. Donald Trump came out sort of swinging and clearly was going to be attacking Joe Biden on everything from the border to inflation, attacked his family, attacked his son. And Joe Biden was really on the ropes almost the entire debate. He stumbled a lot. He froze at one point before the camera. He had some faltering statements throughout. On occasion, he kind kind of hit back. His voice was faltering. Some in the campaign say he has a cold, and that's why he was hard to hear at times. But certainly this is not going to help Joe Biden in terms of the concerns expressed by many, and certainly a talking point for Republicans about his age at 81 years old, the oldest president, and his fitness to serve. So there's going to be a lot of talk about that. That's already what we're seeing in social media. And on Trump's part, he really came out and sometimes was coherent about policy, but other times was rambling. When asked about the opioid crisis, he started talking about Evan Gershkovich, a reporter held by the Russians, in jail. A lot of times he seemed to be searching for what he was saying, except that he was the one who really was attacking strongly, and Joe Biden was very much on the defensive in this debate.
Yeah, there seemed to be a stark contrast in, who really brought their A game tonight. I mean, how much do you think, Biden's performance could hurt him, especially given those concerns, as you mentioned, about his age and fitness?
Yeah, it could hurt him a great deal. He really needed to come out tonight and show he was strong, that these concerns, some have said that the Republicans were taking various images and putting them together to make him look weak. But then he came out and for an hour and a half tonight just did look weak. And at times, he seemed to not know what he was saying or putting the sentences together. Other times, he did seem like his old self. And at one point, he told Donald Trump that he's a liar and that you just continue to lie. And he tried to make some policy statements, but it was overshadowed by performance. And that's going to be the real concern here. Interestingly, our correspondent in Atlanta was looking for some people, Democrats, to interview afterward in the spin room, and there were very few. Our Atlanta bureau chief said that there really weren't many Democrats there, and you're wondering what their message is going to be, how they're going to try to put their spin on this tomorrow.
And can you mention a little bit more just the key takeaways in terms of what was the topics that were discussed? It's interesting enough. I didn't think we heard too much when it came to trade and the like with China in particular here.
Right. We heard about China only really Donald Trump criticized the current president's policies on China and said he was weak on China, but we didn't hear a lot of prescriptions. We really didn't hear a lot of policy prescriptions much at all. Both men, criticizing the other, very harshly, but there didn't really seem to be, for instance, on trade. Where do you go on trade? What should be the policy on Asia trade? That kind of thing really didn't get much discussion. There was a little bit of talk about, Joe Biden was trying to defend his record on the economy, which has been something he has struggled with in this campaign, given that inflation remains high. But there really wasn't a lot, if you were looking for both men to kind of come up with their statements on their strategy and what would be their policy priorities, you did not hear that in this debate tonight.
Jody, thank you. Jody Schneider there, our Bloomberg political news director, joining us out of D.C. this evening. And let's discuss a little bit more of U.S. election, U.S. markets overall, with Omar Slim, co-head of Asia Fixed Income at Pine Bridge Investments. Omar, it's always great to have you on the program. I mean, obviously we just wrapped up the first presidential debate. Are you getting any sort of clues in the market on how the impact's really going to be once November comes around?
Well, I think Trump is ahead in terms of the predictions at this point, and perhaps this debate reinforced that. At least that's the market's perception. And I think the focal points from the market perspective is what will happen when it comes to the fiscal side, which is becoming more of a focal point for the markets increasingly, actually, particularly given the fact that the Fed seems to be proceeding very cautiously. So fiscal will be more prominent. And the other bit is on immigration, which might lead to a tighter job market, which is inflationary. So I think you could see some kind of reaction on the treasuries from that perspective. I think it's still early days, but these would be the two areas that the market is focusing on.
And you mentioned one of the key market risks is that sovereign risk is creeping in. Is that what you're talking about, some of these fiscal concerns leading, after this election? And what do you think is really going to be the big driver next year? Is it really going to be about deficits, or is it still going to be about this debate about inflation or growth?
Yeah, that's a good question. I think really monetary policy will be the major driver when it comes particularly to the treasury markets, to the safe haven bond markets, as well as the currency markets. But in the absence of strong moves, particularly from the Fed, and what I mean is the absence of the Fed cutting aggressively, which is kind of a safe assumption at this point in the sense that we will probably see some calibration cuts, 1 or 2 cuts this year, and then it remains to be seen what will happen next year. I think the market will increasingly focus on how much fiscal space there is in the U.S. and other places. And I think that's really is deteriorating, and I think it will play a larger role in terms of how the treasuries and the other safe haven bond markets trade. Again, particularly given the fact that probably the Fed will be engaged in more calibration cuts as opposed to starting an aggressive cutting cycle at this point.
And it's interesting, right? If we're going to start worrying about budget outlooks in the U.S., maybe a potential more supply of U.S. Treasuries, does that force you to lean more towards the credit space as well, Omar, now?
Yeah, I think one of the kind of the big things that has happened, very high level, but I think increasingly in display, in full display really, is that there has been migration from a consumer debt and corporate debt into the sovereign side, and that really started and accelerated after GFC, the financial crisis. So I think the market will be increasingly focused on what the fiscal space is. We see it to a certain extent in the U.S. We see it in other places, particularly in Europe. And frankly, funding sovereign debt at 0% or negative is different from funding at 5%. And I think this is a slow-moving phenomenon, but I think it is one that the market will be increasingly focused on.
And you mentioned that there's lack of clarity on the Fed. I mean, that's certainly weighing on Asian currencies here in this part of the world. The yen weakness isn't really helping as well. Does that force you to now look more on dollar assets, too, for the back half? I know you just came out with your new outlook for 2024.
Yeah, I think dollar will continue to be strong. I've said it in your show a couple of times ago. I think there's a few months ago and even last year that the yen will continue to be weak. There's really nothing at this point stopping the yen from remaining weak. Maybe the bulk of the weakness is behind us, but I think it will be weak. I don't think the Bank of Japan will be engaged in an aggressive hiking cycle, and I think the yen will continue to be weak. So it's a bit of a specific case, but more broadly for Asian local currencies, I think the Asian central banks broadly are very reluctant to cut before the Fed does so. I think there are a few of them that are itching to go, Bank of Korea and others. But I think they are concerned about the stability of their currency, and you saw it in places like Indonesia, for instance. So we're more erring towards the dollar side than Asian local currencies at this point. We have had that position for a while, and we continue to have it.
What's your take on high yield then, also, Omar? I mean, obviously, it looks like we're avoiding this whole kind of hard landing scenario in the U.S. Everyone, I've talked to on the show talks a little bit more about this whole export growth that we're seeing and the PMIs around the world that are still turning more positive here right now. Overall, does that lead you to take in more risk, particularly in the junk bond market?
Not really. I think more on the selective cases. So if you talk about the Asia high yield market, there are parts of the segment of that market that we're really disengaged in, and we think that they will continue to be challenged. Others where we see some opportunities. Outside of Asia, I think the market is generally expensive and rich, and this has been the case for a while and probably will continue to be the case because the corporate balance sheets continue to be generally they're holding up reasonably well. So it's more of a carry game at this point, and we're not seeing default rates going up in any meaningful way anywhere, actually. So yes, selectively, but I wouldn't make kind of a broad brush statement saying that we're kind of going overweight high yield at this point.
All right, Omar, thank you. We'll have more from Omar Slim the next block there, Pine Bridge Investments. He's sticking around. Just want to alert some lines crossing here from President Xi. This is from a speech at the meeting commemorating the 70th anniversary of the publication of the 5 Principles of Peaceful Coexistence. That's quite a bit of mouthful here, but they're talking about when it comes to reform. So China planning major measures to further deepen reform and imports from developing nations to exceed 8 trillion renminbi until 2030. Xi also saying China continues to expand, opening up. So it's just some lines crossing there from the president, as of course we did get the official dates for that plenum that's been delayed for months now, July 15th to 18th in Beijing, looking to be quite a catalyst here for markets as well. If we talked to a lot of the traders out there, and this coming at a time when we saw the MSCI in correction territory. Also, the Hang Seng also in similar measure as well, falling some 10% from the high that we saw back in May. Well, still ahead this hour, we're talking about Indian bonds in focus as the nation debuts in JP Morgan's EM bond index and discuss the risks and opportunities with ANZ. Jennifer Kusuma joining us a little bit later on. This is Bloomberg.
We're really just looking at the gains from the bonds because the INR has basically been pegged for quite a while.
Broadly, the market is positioned for the inclusion. However, if you were to look at it more from a structural long-term perspective, I think the move in bond deals is not yet done.
I think putting a time period to it is not going to be fair because we are expecting that after JP Morgan, then the Bloomberg index inclusion will happen, and post that there will be a more confidence from the global investors once they have seen and experienced India that they will come down the credit curve. So I think that this is going to have a rippling effect over years, and I'm not even going to say months.
Well, some of our guests speaking about the inclusion of Indian government bonds in JP Morgan's EM government bond index that begins, yes, today is the first day. We'll get to how things open up in just about the bottom of this hour. And this inclusion will open up India's $1.7 trillion sovereign bond market to international investors, and global funds have been piling in, pouring almost $10 billion into index-eligible bonds since JP Morgan's announcement back in September. Goldman Sachs puts that number could be higher here, predicting that global investment into India debt could go up by as much as $40 billion. And you take a look at this chart, it just goes to show why interest as India bonds have really far outperformed global peers since at least 2022. Of course, foreign ownership still remains quite low, around 2% or so, but some banks have said that could actually easily double just given this inclusion as well. Let's bring back Omar Slim, co-head of Asia Fixed Income at Pine Bridge Investments. People talk about the benefits of getting into this bond market, high yield, high growth story in India. As they do go global, what do you think this means for rates, the currency, and the economy?
Look, I think it's a big day for the onshore India bond market. Obviously, this has been announced a few months ago, and today it's taking place. I think it's positive for India. India has been a generally good story for the past few years, and that's going to reinforce it. And I think, to be fair to the Indian regulators and policymakers, they have been trying to actively and proactively facilitate access to the bond market, which is, as you just alluded to in your comments, it's a very large market and it's an interesting market. I think it's fair to expect that foreign ownership will increase, first driven by some of the kind of passive inflows, which will be relatively substantial. But I think this is a multi-year story in the sense that it puts India more firmly in the global bond market allocations. And I think it adds to the positivity around the India story.
There's still some teething issues, right? When it comes to those tax hurdles, that hasn't gone away. You talk about you could be taxed up to 20% for interest on, earned from these bonds as well. Modi's government also emerged a bit weaker after this election recently. I'm just wondering, what are the risks, though, in investing into this market?
So I would say that there are a few risks. Some are kind of the operational side or the kind of the tax obstacles, which you've alluded to. And I think these tend to historically have been relatively large, dissuading some investors from being active in this market. And there, I think there has been some progress, and still some progress needs to be done. On a more macro level, I think the major kind of risk is that there's a lot baked in the India story, whether you're looking at the stock market or you're looking at the bond market, both onshore as well as offshore. And India has been a darling of the market for some time. So I think given the political landscape that changed, as you said, after the elections, and you're right about that, the risk is that we need to continue to see reforms, we need to continue to see policy actions and decisive actions being taken. Otherwise, that positivity, which is baked in the price at this point, might start to fade.
When you look at the EM bond landscape now, I mean, how does it change with India now being included and maybe taking a bigger pie? Who loses out? Are you seeing or are you expecting certain markets to really see a lot of outflows just given this bond inclusion out of India?
Yeah, some of the other countries will essentially have a smaller weight. Thailand, for instance, is one example from that. But I think it is not a major issue in the sense that what we have been seeing, and that's particularly true for the Asian local currency bond market, is that those bond markets have gained depth. And the investor base, the local investor base, for quite a few of those markets, for instance, Malaysia, we were talking Thailand to a certain extent, Philippines, Singapore, and so on, the investor base locally is quite strong. Whatever we see an investor base which is less strong, for instance, Indonesia, there could be a bit of substitution effect or a displacement effect. But I think that's more on a case-by-case study. I would say for Southeast Asia, that continues to be these countries continue to have generally deep markets, with some exceptions, like for instance, Indonesia.
Omar, it's great to have you. Have a great weekend. Omar Slim there from Pine Bridge Investments joining us out of Singapore. And continuing our coverage of India's bond inclusion today, we also have Bloomberg's Menika Doshi. She's hosting a live webinar right now. If you're a terminal user, you can watch on Live Go. We got plenty more ahead. This is Bloomberg. All right, we're looking at these Chinese markets here right now. Looks like we're doing a little bit better on the onshore market. There you go, Shanghai Composite. We're up some 1%. And in fact, we're getting closer back to that 3,000 psychological level as well. Of course, some Xi lines talking a little bit more about, these more measures for deeper reform. Certainly does build up speculation on what could be announced at the plenum in mid-July, which has been confirmed now. But yes, we did talk about yesterday MSCI China entering into a correction. Hang Seng also in similar sort of fate here this morning. HS Tech is lower by about 0.7%. So you're not getting that support from some of these large caps out of China here this morning. In terms of what we're looking ahead to, it is all about that Fed PCE inflation gauge. Now that we have this U.S. presidential debate on the back, we can turn the page on that here right now. It didn't really do too much in terms of market reaction, though we did see the dollar a little bit stronger before paring back. Here you're seeing Treasury yields at least tick a little bit higher after here in the Asia session here. We're back below to 160 now for dollar yen here as well, 729 for dollar China here this morning. This is Bloomberg. Well, as we've been focusing on here in this hour, India bonds make their debut on JP Morgan's EM bond index today. And Avril, she's been looking at this. It's a big day for India, obviously. But what might this mean for the whole EM bond universe now?
Yeah, absolutely, Yvonne. Big day, long time coming after that September announcement by JP Morgan. I think we've seen net inflows of about $10 billion into India's bond market. So this is really a big moment. But to your question about what this means for some of these other EM markets, if you take a look at where things will be come March next year, where India will step by step have a weighting towards 10%, this will mean that it will come ultimately at the expense of some of these other EMs, the likes of South Africa, Poland, Thailand. They will see their weightings come down, and this could prompt some of these outflows in the bond markets there. The other thing that we're keeping a close watch on as well is whether this really prompts inflows into the India bond market. Certainly that's the base case, but you take in mind China's playbook and how expectations after the FTSE Russell inclusion was like $140 billion of inflows. About a tenth of that, or even less, has actually materialized. Let's flip the board and take a look at what we're seeing at the open of trading for bonds in India as well as the currency. A lot of this, I think, has already been priced in, right? We've seen how India markets have been gaining ground, the bonds, in anticipation of this inclusion. And of course, backing all this is the fiscal consolidation, India's growth story. Don't forget as well, the rupee has been held pretty stable, helped along by the RBI. So all of these positive factors for India's bond market, seeing that further tick up in the 5-year as well as the 10-year at the moment. Slight pullback on the 2-year. Rupee also pulling away from that 83.40 level. Yvonne?
Yep. All right. Just opening up, obviously just confirming now that those bonds, of course, have been included in that JP Morgan EM bond index as well. So we'll continue to track this one throughout the rest of the hour as well. Obviously, April, stick around. We'll talk a bit more about this and bring our next guest, Jennifer Kusuma, Senior Asia Rate Strategist at ANZ. Jennifer, it's always great to have you. Can you just tell us, how significant this moment really is for India right now, and how do you compare it to, EM bond inclusions we've seen in the past?
Thanks for having me. So this is a very big step for India's market development. We do think an index inclusion, especially a key index like what we saw today, is an important step in the development and deepening of the domestic markets. So in the near term, yes, a lot of inflows has come in. Many foreign investors have a position in the market. But what an inclusion like this would mean is that a wider set of foreign investors would be encouraged to participate. So we can expect diversification and even more broadening in the investor base. And in the long term, I would also argue that this could open the path to more inclusions into other key global bond indices in the medium term, obviously. So this is a very exciting and a positive step for the Indian bond markets from the investors' perspective. I think the comparison we may have to today's would be the nearest would be the China government bonds inclusions happening between 2019 and even up until now, the weekly inclusion like April mentioned earlier. But I would highlight that in the period of 2019 to 2022, we did see a big amount of inflows coming into the market. I would say the estimate would be roughly about $240 billion on a net basis into the market. Not too far off, estimates of the full estimates about $300 billion until the end of a weekly inclusion. And bear in mind, weekly inclusion is still ongoing right now until September 2024. So the implication itself during the early days and 2019 to 2022, so that's a good 3 years run. Foreign ownership rose from 7.5% of a CGB market to above 11%, and that's not all. There were other inflows into agency bonds, including the PFB as well. So I would say the net impact is positive, but of course, in the longer run, macro dynamics, market outlooks, and other global factors would determine whether foreign investors continue to come in or trade it relative to other markets.
Jennifer, ultimately, what do you think this might mean for government borrowing costs? Do they come down over time? Especially, as we look at the closely fought election, what is this going to mean for Modi and some of these spending plans, fiscal consolidation?
There have been studies, over a big set of data that foreign participation tends to lower government funding borrowing costs. But in India's case, I would say market has largely priced in a lot of the good news. Again, Avril, all the factors that you mentioned in the preview of this section. So in the very near term, I would expect more stable trading environment. Maybe the 10-year yields could edge towards 6.8%. Our own assumption is that by the end of the year, the RBI may have the window to cut rates one time in December, and further rate cuts in 2025 could, guide yields further lower. But for now, around 7% down to 6.8% seems to be good clearing levels between the interest to buy as well as profit-taking interest for now, especially considering that the RBI is keeping a hawkish monetary policy stance.
How do you think, investors should look at, the risks in this market? I mean, obviously the old sort of concerns used to be about high oil prices, runaway inflation, also fiscal deficit concerns. Are those still sort of risks that we still need to deal with, or are there new risks that we have to look at in this market now, Jennifer?
Those are the main risks, but I would say to less extent. We still have to be very vigilant, especially on the inflation volatility. But let me address your query in three parts. So on the fiscal stability, I would say this has been a concern since the election results, obviously. Our own view is that we do think the government would stay on a fiscal consolidation path towards a budget deficit of 4.5% of GDP by the end of FY26. This is constitutionally mandated by the Fiscal Responsibility and Management Bill. So unless growth really surprises to the downside, we don't think there will be much room for the government to deviate away, or willingness to deviate away from this target. That's on fiscal. On the current account, that generally tends to be driven by oil demand and oil prices. Therefore, whenever oil prices rises, the current account as well as the INR tend to be under pressure. Now, one key development for India is the rise of services exports. So this has been quite significant. Yeah. It is structural in nature, and to some extent, it will mitigate, the volatility that we are seeing, especially in the goods deficit. Last, on inflation, this is a bit more complicated. Now, in the near term, we are encouraged by the fall in core inflation. That means RBI's monetary policy stance has been effective. However, monsoon remains a key risk in the medium term. The spatial distribution, the amount of rainfall that we will see between June and September would determine, whether that room for rate cuts will be open in Q4, for example. And in the longer term, I would say for India's case, volatile food component would remain to be a key thing to watch.
Right, Jennifer. Really hard to sometimes predict the weather and how that plays out in food inflation in India. But I want to get your sense as well. Does this inclusion perhaps also come at the expense of these other EMs? I mean, we talked about how we could see a bit of outflow in Thailand, but particularly for other Asia EMs such as Indonesia, that sees a bit of, concerns about lax fiscal policy.
So I would separate this into two parts. The first is the structural decrease in the index weight itself. So on the back of India's inclusion, only Malaysia and Thailand in Asia would see a reduction in the weight, roughly about 1 to 2%, equating, maybe between $2 to $4 billion in total. So that is not significant with respect to the size of these markets, as well as the involvement of the domestic investors base in that. So on the back of the passive reduction in the weight, I don't think it is going to be an issue. Now, more interestingly, I think is that Asia is increasingly looking at idiosyncrasies in the region. And this will, to an extent, determine the outlook of the market and what investors choose to do in terms of having their relative exposure. You mentioned Indonesia. I would say at this point, Indonesian local markets have been hit on two levels, really. On the first is really the delay of a U.S. Fed rate cutting cycle. For economies with more vulnerable external positions like Indonesia, this is really bad news. And the second layer is really the rising uncertainties on the policy outlook, especially on the fiscal policy outlook. with the upcoming government. So it is being weighed down. Currently, sentiment is being weighed down by these two.
Yeah, I was going to get to the Fed discussion because it seems like a lot of EM currencies seem to be more sensitive to the yield gaps that we're seeing with the U.S. The rupee, though, in India has been quite resilient in the face of that macro backdrop. Do you think the RBI can still manage this currency and keep it stable?
Very well, and that is really our expectation, that they are not really letting go or deviating away from their FX management style that we have seen recently. So we do expect the rupee to be trading relatively quite stable. We have a forecast of 83 by the end of the year and 82 by the end of 2025. One important development in India is that the FX reserves of the RBI is really quite significant, and they have telecasted that they plan to absorb most of the bond inflows into their FX reserves. So if we just look at the IMF's metric of looking at FX adequacy ratio, comparing your FX reserves to the potential sources of outflows in a balance of payment crisis, so in a crisis time, India's ratio is about 175, way above, the recommended range of 100 to 125. So I think India's external position is really one bright spot in the economy, and the central bank does have significant tool to defend the currency.
Jennifer, thank you. Jennifer Kusuma there, Senior Asia Rate Strategist at ANZ. Also, our thanks for Avril Hong for joining in on the discussion as well. We have some news to break here when it comes to Bharti Airtel. Now, they are raising the India mobile plan prices after what we heard from Reliance and their hike as well. So that's why you're seeing the stock doing this here right now. We're up some 4% as markets open up in India here this morning. We'll continue that discussion coming up. Plenty more ahead. This is Bloomberg. Well, during the presidential campaign debate in Atlanta earlier, former President Donald Trump claimed his strategy to enact a 10% across-the-board tariff on imports would reduce U.S. deficits in check countries like China. But President Biden said that plan would hurt Americans. Take a listen.
We now have the largest deficit in the history of our country under this guy. We have the largest deficit with China. He gets paid by China. He's a Manchurian candidate. He gets money from China. So I think he's afraid to deal with them or something. But do you notice he never took out my tariffs because we bring in so much money with the tariffs that I imposed on China. He never took them away. He can't because it's too much money. It's tremendous. And we saved our steel industries, and there was more to come.
If it's 10% tariffs, everything coming into the country, you know what the economists say? That's going to cost the average American $2,500 a year more because they're going to have to pay the difference in food and all the things that are very important.
Yep, some comments there when it comes to tariffs, foreign policy from that presidential debate that wrapped up about an hour ago in Atlanta. Let's get to our China correspondent, Min Min Lo, joining us in the studio for some analysis here. Yeah, we didn't hear a lot. I thought we were going to hear more about China, but we didn't get a whole lot of substance in this debate as well. But, how do you see the two candidates defining themselves in this debate?
Yeah, I mean, the tariffs was in focus. They didn't talk specifically about China a lot, but you heard by Trump saying that he would impose this 10% tariffs on all goods coming into the country, and he denied that will cause any inflation. Instead, he says that it will cause all those countries that are ripping the U.S. off to give them a lot of money and reduce those trade deficit. I'm paraphrasing what he says here, of course. The Biden administration has so far really been defining themselves against its opposition by saying that their tariffs so far far has been very targeted. If you look at those recent tariffs on EVs, medical devices and the like, it's only constituting about $18 billion worth of goods between China and the US, which is still very small overall if you just, in the overall scheme of things. But of course, Biden, analysts have also said that Trump, may be more buck than bite. They said that, he may threaten this 60% tariffs, but when it does really hit inflation, he may just use this as a form of leverage over China to extract some concession in exchange to, to not reduce, to not impose those tariffs or to reduce those tariffs.
And there was also the topic of immigration that came up a lot. How do the two candidates differ when it comes to immigration policy?
Yes, they spent a lot of time on immigration, although they did not explicitly target Chinese immigrants. But we know that that has been a campaign issue because last year, the U.S. had arrested over 37,000 Chinese immigrants, which is a tenfold increase from the previous year. And Trump has, of course, said that these immigrants are taking away American jobs, that they are wiping out Social Security. But Biden, of course, defending his policy, saying that his policy so far has led to a 40% decline in illegal immigrants. We know that Biden administration has been trying to offer some form of protection for undocumented migrants that have been in the U.S. for a long time, especially those that have shown themselves to have established careers and families. But Trump, on the other hand, has said that he will be deporting millions of them if he comes into power.
Yeah, it's interesting what we heard about Ukraine, the Israeli-Hamas war as well. I mean, Donald Trump did also just call Biden there a Manchurian candidate who was paid by China as well. Obviously, no evidence in that as well that he didn't really approve. But overall, China really was brought into this discussion about how they look at the Ukraine situation here right now, too.
Yes, so, I mean, you heard Trump really kept up this stream of criticism really against President Biden. He brought up Biden's mistake in Afghanistan, saying that the withdrawal of troops there was the most embarrassing moment in American history. When it comes to the Hamas war, he did not really directly answer a question about whether he would support an independent state of Palestine, but instead he says that the U.S. should allow Israel to continue its attack and let them finish their jobs. When it comes to Ukraine, he says that he will solve and end that conflict really quickly as president-elect before he even stepped into office. And he says the U.S. is just spending way too much money with these weapons and aid to Ukraine. But of course, President Biden again defending his foreign policy, saying that it's critically important for the U.S. to really maintain its allies with other countries. He says one must be really aware of Putin's broader ambitions beyond Ukraine. He may go after other Eastern European countries as well.
Min, thank you. Min Lo there, China correspondent, with a bit more analysis on what came out from that U.S. presidential debate. When it comes to China, of course. Meanwhile, the U.S. ambassador to China says Beijing has misjudged the impact of its support for Russia's war in Ukraine. Nicholas Burns told us that China is not remaining neutral in the conflict and further sanctions are possible.
We put a red line in front of the Chinese 2 years ago, just after the Russian invasion of Ukraine, and we asked the Chinese government not to extend lethal assistance to Russia. We don't believe the government has done that. But what's happened is that the government of China has permitted a considerable number of Chinese firms to sell dual-use technology into the Russian defense industrial base, so that that defense industrial base is far stronger now than it was even at the beginning of the war. We're strongly opposed to this. We think it's escalatory. And Putin has launched a brutal war against Ukraine's government and civilians, and it ought to stop. Chinese say, well, we're neutral in this war. They're not neutral. The actions of the government in allowing Chinese firms to sell these dual-use technologies is very troubling. It's damaging to the effort to end the war, and China is not exhibiting the behavior of a neutral country. So it's a very important difference we have, and we've complained to the Chinese about this at great length, at very senior levels. And as you know, we've begun to sanction individual Chinese companies involved in this. We're going to continue to do that because we have not seen any change in the position of the government of China to help the rest of the world, and certainly Europe and the United States, end this war and make sure that Putin can no longer rain terror down on Ukrainian civilians.
From your position as the ambassador in Beijing, how do you think China is reacting to that summit between Kim Jong-un and Vladimir Putin? The assumption is he's looking for support, he's looking for perhaps arms. He also went to Vietnam. How does this escalate the situation in this part of the world?
Well, the summit was troubling because, of course, Putin wants ballistic missiles and other technology from North Korea to prosecute the war in Ukraine. And of course, Putin wants to sell energy to North Korea as well. And I can't speak for the government of China, but you did see a fairly muted reaction to it. You'll have to ask them what they think of this situation. But certainly the efforts of Russia and North Korea, and in some cases China and Iran, that constitutes a major threat to the democracies of the world, and we're not happy, obviously, with what the North Koreans have done, what the Iranians have done to support the Russian war effort.
That was the U.S. ambassador to China, Nicholas Burns, there speaking with our chief North Asia correspondent, Stephen Engel. Now, let's check in on India markets. Now we're just into a couple minutes into trade here and see how things are shaping up. Looks like equity markets are still doing well and really kind of following what we're seeing across the region here this morning. So we're up about 1/5% for the Sensex as well. The rupee is gaining a bit of ground here as well. Of course, it is the official first day of Indian bonds being included in the JP Morgan EM bond index as well. We'll see. Obviously, we saw a lot of inflows heading into this day. A bit of a mixed picture here right now, but you are seeing maybe a bit of a pause here today in that buying. Their yields are ticking a bit higher in the 2-year yield as well. Not much movement when it comes to the 5 and 10-year, but certainly a big, big historic day for India. We got plenty more ahead. This is Bloomberg. We have some breaking news coming through when it comes to India. The Delhi airport now, after a terminal, the airport terminal roof collapsed so far. What we're hearing is that there might be some injuries there as well as casualties. We'll watch that very closely. But the Delhi airport has now suspended flights because what really happened here was maybe heavy rain that collapsed that roof today. So we're watching very closely. So Terminal 1 temporarily suspended all departures from that terminal after that canopy did collapse here as well. We're hearing that airlines like Indigo, SpiceJet also have delayed or at least canceled some of their flights until 2 p.m. local time. That's the situation that we have so far. Some more other stories that we're following for you. Japan is reportedly getting a new currency chief. As the yen trades near its weakest in almost 4 decades, the Nikkei Shimbun says that Atsushi Mimura has been appointed the new vice finance minister for international affairs as Masato Kanda retires. The move is part of a normal personnel rotation and not seen as a change of direction for Japan's broad currency policies. And polls open later Friday in Iran's presidential election to select the replacement for Ibrahim Raisi, who was killed last month in a helicopter crash. 2 of the most conservative candidates have stepped aside ahead of that vote and strengthening the chances of 2 other hardliners. 4 men are in contention for the presidency, including the poll's only reformist candidate. And, of course, a lot of political risks that we're dealing into heading into the weekend as well, not just when it comes to there, but really France. That's going to be the key one. The first round of voting kicks off here this weekend. Certainly is going to be a high-stakes sort of vote that we've seen in decades as well. Also coming ahead here, China PMI numbers on Sunday as well. Unlikely to see a whole lot of movement in those numbers, but certainly could dictate how markets react on Monday as well. You take a look at how the French election is playing out so far across markets. When it comes to Haute and Bund futures here, this is what's doing it right now. Pretty mixed picture so far, but certainly when it comes to the spreads blowing out, we're still talking about, I think, 82 basis points between the 2 Haute and Bund spreads here right now. So still not quite seeing a full recovery there when it comes to the election risk in these bond markets. That's it from us here from Bloomberg Markets Asia. Have a great weekend.